Good morning, good afternoon, and good evening to you, ladies and gentlemen, depending on the time at which you are watching this video. I just want to welcome you all to this our lecture on flexed budgets and variance analysis. As part of our week 9 lecture series in the paper, the ACA paper MA, the Management Accounting paper, we are pursuing the theory of standard costing, and much of the issues has been covered in the lecture notes. In this particular video, we are going to present a problem involving flexed budgets and some variance analysis so that we understand how to compute these variances and so forth. Now, I'm sure we all understand what variance analysis is, or rather what a variance is. A variance is any deviation from the budget. Okay, so the variance is the difference between budgeted activity and actual activity. Okay, so such differences are considered variances. Now, when you are talking of flexed budget, this is a budget that is adjusted in relation to the actual activity. Okay, it is flexed or adjusted to match the actual things obtaining on the ground. So let us go through this particular question and see if we can make sense out of these definitions. We are given example Zulu there. All right, this is a company called Zulu, and it has prepared its cost card as shown on the screen. We have got materials which are required to produce this particular product, which are 5 kgs. Okay, so 1 unit of the product needs 5 kgs, and each kg is costing $5. Then labor required per unit is 4 hours at $4.50 per hour. Variable overheads, that's 4 hours at $2 per hour. Fixed overheads, that's 4 hours at $3 per hour. So using your principles or your previous knowledge, you could easily see that this cost card was actually prepared for an absorption costing environment where we are including both the variable costs. Okay, these are variable costs, materials variable costs, labor variable costs, and these ones variable costs, but these ones are fixed costs. So obviously this is the total absorption cost of the product. Okay, then we are also told that the budgeted selling price was $85 per unit. Okay, that's the budgeted selling price of each product. Then budgeted production, we are told that they are aiming to produce 5,800 and to sell 5,000. So which means the budgeted closing inventory, in this case budgeted closing inventory is 800 units. Okay, that's budgeted closing stock. Okay, we also told that there is no opening inventory. Then the actual results are as follows. So what actually obtained on the ground was that they sold 5,400 units and produced 6,000. So the actual closing stock was 600 units, because they produced 6,000 but only sold 5,400. Okay, but as you are looking at these two figures, these two groups of figures, you can see that there were some disparities in terms of the number sold, the budgeted units um, produced, okay, were 5,800. All right, that was the budgeted production, but actually what was produced were more units. That is 6,000 units were produced, and we need to investigate what could be the reason behind the excess production. Also, you can also see that we were planning to sell 5,000 units, but we ended up selling 5,400. We also need to know why there was such an increase in sales. Okay, we are given the actual event where we are being told that materials, the actual consumption of materials, or the actual materials which were used, were 23,856 kgs, and these costed 118,455 dollars. And labor, we paid 25,000 hours, but the labor that was actually worked was 23,100 hours, but we paid for 25,000, that is 99,580. Variable overheads were 49,340. But here on the labor, you can see that if we paid 25,000, but the hours which were actually worked were 23,100, it means that there has been some idle time. Idle time was paid. Okay, fixed overheads, we ended up incurring $71,011. Okay, now we are required to prepare a flexed budget and to calculate the total variances. That's our first task. So let us do that, ladies and gentlemen, to see if we can make something sensible. So we need to be very systematic, okay, in our computations. So we need some columns, okay. We need about 4 columns. Okay, and this one is for the original budget. Original budget. Okay, original fixed budget. Let me just call it fixed budget. Original fixed budget, and then we need the flexed budget. Then the actual transactions which took place, or actual results. Okay, and then on this last column we do our variance analysis. The variances. Now let's list the transactions on this side. We've got the sales, all right, the sales in units. The original budget was telling us that the sales were supposed to be 5,000. Okay, they were supposed to be 5,000 in terms of units. Okay, whereas the budget production was 5.8. So let us slot in those first two figures: production in units. Okay, the sales were supposed to be 5,000, whereas the budgeted production was supposed to be 5,800 units. All right, but now for the flexed budget, we are based on the actual. We need to flex. We flex based on actual activity. Okay, we flex based on actual activity. So the actual activity was this one, okay, where we have our sales 5,400 versus our budget, our production of 6,000. So we slot in those figures: sales 5,400, and then production 6,000. Okay, and under the actual results, we slot the actual as they are. Now we then start to compute our figures in monetary terms. Remember, these ones are in units. Okay, these ones are just units. Now the sales in monetary terms, the sales, we know that we let's start with the original budget, the fixed budget. We know that we were planning to sell 5,000. Okay, at how much? The planned price was this much, $85 per unit. Okay, so multiply by 85. Multiply by 85, and we should get our 425,000. Then we move on to the cost of sales, and this is made up of all the variable and fixed costs of production. So we start with the materials. Materials. Our materials is also going to be based on the units, the budgeted production. That is, we were budgeting to produce 5,800 units. Okay, and each unit requires how much according to the cost card? Each unit requires material worth $25. All right, so we are going to slot in the $25. Apply by 25. Okay, so we are going to get 145,000. Okay, and at this, it is a good practice to just demarcate this figure. Okay, so that when you make your computations for all the cost of sales, you're not going to be confusing those figures with the sales figure. All right, so let us finish the original fixed budget first. Now, labor. According to the budget, we're aiming to produce 5,800 units multiplied by the cost of labor per unit. In this case, labor per unit in total is $18. So multiply by 18, and we should get this figure. Let me just use my calculator here. Okay, so we are going to have 104,400. Okay, we move on to the variable overheads. These ones are also based on the production quantities budgeted for, that is 5,800 multiplied by the overhead cost per unit, variable overhead cost per unit of $8. Don't forget to put the dollar sign. Okay, and that should give us 46,400. Then fixed overheads. These ones are also based on the budgeted activity applied by the fixed overhead cost per unit, that is $12. Okay, so we are having 69,600. So let's add up all these costs from 145, 105, 400, 46, 400, 69, 600, and we must get 365,400. Okay, and then we need to then deduct from this closing inventory. Closing inventory. The closing inventory here, according to what we determined, the closing inventory for the original budget was this one, 800 units. So we say 800 multiplied by the cost per unit, and our cost per unit is determined from the cost card. Okay, $63, and we get 50,400. We then have to subtract it from the 365,400, and we must get 315 as the total cost of sales. Okay, and if we subtract this cost of sales from the sales of 425,000, we get our profit, and the profit should be 110,000. So the original budget was showing a profit of 110,000. Let us now try to come up with a flexed budget showing what the profit should be based on actual results. Okay, what the profit should be based on actual activity. That's the flexed budget. Now for our sales, okay, for our sales, we have to be guided by the actual things on the ground. Okay, now care should also be given to the figures which one has to apply or to use, because you might end up manufacturing the actual results or constructing figures which are similar to those of the actual result. What is going to change when we are talking of flexed budget is the units. Okay, the units are going to be adjusted to reflect the actual activity on the ground, but the prices or the costs are going to be as per those reported in the cost card, the budgeted cost card. Okay, so for example, for the sales, we are having a situation where we are going to say actual sales units 5,400, okay, multiplied by the budgeted sales price of 85. Okay, which means our sales are going to be, let us use the calculator, that is 5,400 multiplied by 85. We are going to have 459,000 $459,000. $459,000. Okay, these are our sales. Then for the materials, labor, and so forth, we are going to be guided by the actual production. The actual production was 6,000 multiplied by the budgeted material cost. Okay, the budgeted material cost was $25 per unit, so which means 6,000 multiplied by $25 per unit, we are going to have 150,000 for materials. For labor, we use the same figure, 6,000 multiplied by the labor cost. The budgeted labor cost per unit was $18. So $18 multiplied by 6,000, and we are going to have 108,000. For variable overheads, we are also going to have 6,000 multiplied by the variable cost per unit of $8, and this should lead us to 48,000. Okay, for the fixed overheads, we are also going to be guided by the actual activity. Okay, and the cost was $12 per unit, and we have our 72,000. We add up these figures. We must add up the figures, and we get our 378,000. Okay, and then our closing inventory should be based. The closing inventory should be based on the actual closing inventory according to what was obtained on the ground, and we determined that this was 600 units. So we are going to say 600 units multiplied by the budgeted cost of production according to the cost card. This was $63 per unit. So that's 63, which means our closing inventory was 37,800. We separate this figure from 378,000, and we should rest at 340,200. Then we separate this 340,200 from the sales figure of 459,000 at the top there, and we get our profit as 118,800. All right. There is actually no point of putting the dollar sign there because the dollar sign is there at the top. Okay, that might annoy examiners. Okay, that might annoy examiners. Okay, we've done our flexed budget. Now, the actual results we just have to slot in using the figures that are given. All right. For example, the sales, we are told that the sales which were actually made were 423,200. So let us just slot in those figures. 423,200 we underline as usual. And then for materials, we are also told that material was actually this one, labor, that one. So let us slot in those figures. For materials, that's 118 455, and for labor we have got 99 518, and variable overheads 49 340, and fixed overheads we have 71 011. Okay, we add up these figures. We must rest at 338 324, and then we deduct the closing stock. The closing inventory should actually be the same as that one reported in the flexed budget of 37,800. All right, and if we deduct, we should get 300 524. if we subtract this 305.24 from the sales figure of 423,200, we should get a profit. I said there is no point in endorsing a dollar sign there because already there is a dollar sign at the top. So that's 122,676. Now we are having the actual results, the flexed budget and the original fixed budget. We then have to do the variance analysis there, okay, and this starts, this is done on these monetary amounts. So for the sales, we are having 459, all right, minus 423,200. Let me find out from the calculator. Okay, we get 35. Sorry, let me try to use another pen, a white pen. 35,800. But as you can see that, here, our budget was telling us, the flexed budget is telling us that 5,400 units when sold should fetch 459,000. However, in this case, they fetched 423,200. So this is an adverse variance because we end low sales. Then when we look at the material costs, okay, the material costs, the budget is telling us that if things went according to plan, things went according to plan, we were supposed to incur a cost of 150,000. However, we incurred a cost of 118,000. So obviously this should be a favorable variance. 545, which is favorable. Then for the labor, the 5,400 units should have costed 108,000. The 6,000 units which were produced. Remember, for the cost, we are looking at the production quantities. All right. So the 6,000 units which were produced should have costed 108,000, but they costed 99,518 thousand. So this one again is a favorable variance of 8,482. And I'm sure you are following. When it comes to the determination of the variance itself, this is the difference between the flexed budget and the actual result, and we get the difference. The variance there. Okay, it is favorable if the cost is lower than planned. When it comes to sales, if the sales are lower than planned, then it is adverse. But if they are higher than planned, then it is favorable. So simple as that. Then for the variable overheads, we ask ourselves, 6,000 units produced should have costed, in terms of variable overheads, 48,000. But they costed 49,000. So there was an adverse variance because we incurred more costs of 1,340. Adverse. Then for the fixed overheads, we were planning to incur 72,000 when we were producing 6,000 units. However, we ended up incurring $71,011. So that was a favorable variance of 989. Okay. Then we come to the profit. We're aiming to achieve a profit of 118,008 of 122,676. So there is a favorable profit of 3,876. Okay. This is favorable. All right. Now, for this profit, you could also determine this figure by just adding up all these figures, adding or subtracting wherever appropriate. For example, the 35,800 adverse figure is a negative figure, but the favorable ones are positive figures. So if you do the additions there, you should come to this particular figure. So simple as that. Okay, let's see if we have got something else to talk about. Now, we then need to analyze these variances in terms of material prices, usages, variable overheads, and so forth. All right. So let us proceed a step further. Now, using the data from the Zulu core example, we need to analyze each of the cost variances as follows. So we need to analyze the material variances, labor variances, variable overhead variances, and fixed overhead variances to ensure that our objective has been met. Now, we just have to have this question again for our convenience so that we avoid the back and forth movement on the screen. Now, this is the same information we are using, ladies and gentlemen, and let us try to comprehend. Let us first determine the material variances. So we have got two forms of variances. We've got the price variance and the usage variance. Let us first determine the price variance, material price variance. So let me take this clear pen. Okay, material variances. Let's start with the price. Okay, the price variance. Now, this is based on the actual purchases. Okay, actual purchases at actual cost. All right, actual purchases at actual cost. The actual purchases at actual cost. And from the question here, you could see that we have got this information. This is the actual purchase. The actual purchases were in terms of kgs 23,856 kgs. All right, and they costed 118,455. Okay, so in this case we are looking at in terms of kgs, the kgs which were actually bought 23,000, okay, 856 kgs from the question. All right, and their cost was 118,455. Okay, now we then have to say this cost at standard cost of $5. How much should they cost? These actual quantities of 238,000. I mean 23,856 thousand kgs. How much should they have costed, or how much should they cost? That's 23,856 multiplied by $5 per kg, because a kg according to the cost card is $5 per kg. Okay, so if we use our calculators nicely, we get our 119,280. Okay, get this amount. So obviously, in terms of costing, we are having a variance of, or the difference there we are having is 825. The question is this favorable or adverse? Now, if you look at these figures, you could see that the actual material cost was 118,445. But according to the plan, we were, these 23,856 kgs should cost 119. However, they costed 118. So this one must be favorable. The variance is favorable. Okay, then let's talk of the usage variance. Now, usage variance. This shows the materials which were actually used. Okay, so we are given this the figures from the question. Okay, we're given these figures. The materials which were actually used were 23,856. So we come here and say actual usage was 23,856 kgs. Okay, but standard usage for actual production we actually produced how many units? We actually produced 6,000 units. So that's 6,000 units. Okay, multiplied by how many units according to the plan? Each unit requires 5 kgs. Okay, so multiply by 5 kgs. So in terms of budgeting, the actual units produced of 6,000 should take 6,000 multiplied by 5 kg, that is 30,000 kgs. So obviously we are having a variance of 6,000, okay, 6,144 kgs. 6,144 kgs in terms of quantities. As you are looking here, you can see that we actually used low materials or lower quantities of materials, okay, or we used less materials. So we then have to multiply this figure with the budgeted cost or the standard cost. So multiply by the standard cost of $5 per unit, because according to the budget for materials, the material cost or material budget was $5 per kg. So we come here and say this should give us 30,720. Is this variance favorable or adverse? This is favorable because we used less materials. Okay, we used less materials. We used only 23,856 kgs instead of 30,000 kgs. Okay, now to determine if you have done your computations correctly, you can verify using the direct material cost variance computation. Okay, so direct material cost variance is given by material price variance, okay, plus material usage variance, okay, which is equal to, in this case, 825. This is a positive figure because it is favorable, plus 30,720, which is also favorable, and we get a total of 31,545. However, the material cost variance itself has got a formula of budgeted, okay, budgeted cost of actual production, budgeted cost of actual production. In this case, this is 6,000 units, which was actually produced, multiplied by 5 kgs, okay, per unit. Each unit, according to the budget, requires 5 kgs of materials, okay, and each kg is costing $5, all right, per kg. So this gives us 150,000. We then have to deduct, we say less, all right, the actual cost, less actual cost. The actual cost, according to the question, we determine this as 118,455. So this is 118,455. So if you remove this from 150, you should come again to 31,545, which is favorable, okay, because according to the budget, the 6,000 units were supposed to take $150,000, but they did take 118,455. So you can see that the variance is positive. But the important point I wanted to make was that when you see that if you add up your price variance of 825 and your usage variance of that one, you should get the figure of this much, okay, and it should also tally with the direct material cost variance as computed there. Okay, and I'm sure there we are loud and clear. Now let's move on to other variances which we need to determine. We have only done the material linked variances, okay, we have done the materials. Let us move to the labor portion to see if we can make something meaningful. Okay, for the labor, we can do the same thing as we did to the materials. Okay, there is what is called a direct labor total variance, which we might use to cross-check our computations. Sometimes the examiners would require it directly, or he doesn't require it, and you just have to use it on your own to cross-check your computations. Okay, so let's do for the labor. Okay, for labor, Let's start with the rate of pay variance. Rate of pay variance. Okay, the rate of pay variance is based on the actual hours paid at actual cost. Okay, the actual hours paid at actual cost, and we are told from the question here that the actual hours paid were 25,000 and they costed 99,518. Okay, 99,518. Okay, but these costs, remember, we are talking of 25,000 hours. Okay, but at standard cost of $4.50 per hour, this should have, the 25,000 hours should have costed, the hours should have costed 112,500. So obviously, are we having an adverse or favorable variance? This should be 12,982. Is this favorable or adverse? Okay, this was the budget, but this was the actual cost. So this one, obviously, as the actual cost is lower than the budget, therefore this one is favorable. Then let's move on to the next variance in the labor category. We have got we can do the idle time variance. Okay, the idle time variance. The idle time variance can be inferred because we can see here that we paid for 25,000, yet we worked for 23,100. So obviously there is need for us to compute the idle time variance. So actual the actual hours paid 25,000 obviously, but actual hours worked were 23,100. Okay, remember these are hours. All right, so obviously there is 1,900 hours. Remember, idle time is just adverse because no company wants idle time, so obviously the variance is adverse. Now these multiply by the standard cost. Okay, each hour is being paid at $4.50. Okay, this is standard cost. So obviously we're going to have an adverse variance of 8,550. And an idle time variance is always adverse. Okay, now let's talk of the efficiency variance. Let's talk of efficiency variance. Efficiency variance. Okay, I'm just putting a var. It's just a shortcut for variance. So here, I doubt if the blue pen is visible. Let me use the white. Okay, the actual hours worked. We know that they were 23,100 according to the question. Then standard hours for actual production. The actual production The actual production is 6,000 units, okay, and each unit requires 4 hours according to the question. So obviously 6,000 multiplied by 4 hours, we should have worked 24,000 hours. We should have worked for 24,000 hours, all right, but we worked for 23,100 hours, so we get a variance of 900 hours. All right, so this one is at the advantage of the company because we worked less hours, so that's favorable. We then have to multiply this at standard cost per hour of $4.50. This is, and we should get a favorable variance of 4050. This is favorable. Okay, it's an F there. That's favorable. So we have our three variances for the labor and for the labor expense. So we then have to we can cross check, okay, because we know that okay, let us try to compute here on this same portion. We can compute our, or can just use this other page. We can compute the direct labor total variance. All right, this one is based on budgeted, okay, budgeted cost, the budgeted cost of direct labor okay, for actual production. The actual figures, we produce 6,000 units, and the labor per unit requires 4 hours according to the budget applied by the standard cost of labor per unit, per hour of $4.50. So therefore we get 108, okay, 108,000. Then we need to deduct the actual labor cost. The actual labor cost is determined in the question, and this was given as 99,518. Okay, so we have 8,482. 8,482. Is this variance favorable or adverse? All right, the budget was 108, however the actual cost was lower, so this should be favorable. Now let us cross check to see if our figures are okay. So for the direct labor total variance should be labor rate variance plus labor efficiency variance plus idle time variance. So our labor rate variance was this one, 12,982. 12,982 plus the labor efficiency variance, which was this figure, okay, 4,050. Okay, and then the idle time variance, which one? This one is adverse. So 8,550. So if we do the additions there, if you do the additions, you should come to 8,482 favorable. Okay, that's the computation, ladies and gentlemen. We then have to move on to other variances. In this case, let's try to do it quick with the variable overheads. Variances. Okay, here we simply need only two variances, that is the expenditure variance, the variable overheads expenditure variance. This one is based on actual hours at actual cost. Okay, actual hours at actual cost. If we get back to the question, we can see that these were $49,340. That's the actual cost, $49,340. Okay, and then we know that from the information given, okay, from the information given, the actual hours which were worked were 23,100. Okay, so the actual hours were actually 23,100. All right, and these should be at standard hours. At standard hours, I mean, not hours but cost. At standard cost. The standard cost for variable overheads from the cost card, we know that it was $2 per hour. So 23,100 multiplied by $2 per hour, we get 46,200. All right. So we are going to have 3,140. Is this variance adverse or favorable? Now, the actual cost incurred was 49 versus the budget of 46,200. So therefore, this should be an adverse, as the actual cost was higher than the planned cost. Then, what about the variable overheads efficiency variance? Let's do the efficiency variance. Efficiency variance. This one is based on the actual hours worked, and we discover that these ones were 23,100 hours, okay, and versus the standard hours of actual production. Actual production, we know that 6,000 units were actually produced, multiplied by the standard hour. Okay, the standard hour per each product. The standard hour, if you come back to the standard cost card, you can see that is 4 hours. The standard variable overhead hour is 4 hours. So we are looking at 24,000 hours. Okay, so the difference is 900 hours. Is this favorable or not? Okay, you can see that it is favorable because um, the actual hours are lower than the planned hours. So then we then have to multiply by standard cost. The standard cost, the the uh, overhead, the variable overhead cost. The standard cost according to the cost card is $2. Okay, this is $2 as you can see there. So multiply by $2. Then we get 1,800. This is favorable because um, we are having lower actual hours worked and high budgeted hours. Okay, we're having lower actual hours worked against high budgeted hours. So we did the right thing. Now let's talk of the last element because we have done a lot here. We have done the materials, the labor, the overheads. Now we are left with the fixed overheads. Okay, so the fixed overheads, the actuals were 71,011. So fixed overheads, fixed overheads. Here we are looking at three variances. The first one should be expenditure variance, expenditure, fixed overheads, expenditure variance. Okay, this one is based on the actual fixed overheads incurred. The actual fixed overheads incurred were 71,011. Okay, and the original fixed budget was showing how much? The original fixed overhead budget was showing how much? We can just do that. We determine that through computation. Okay, the original plan was that the cost cut, the fixed overheads per unit was $12, and the production plan was based on 5,800. So which means 5,800 units multiplied by $12 per unit of fixed overheads, which must get our 69,800. Okay, 69,600. So we then have to take this figure 69,600 and we should get an adverse variance. Why? Because the actual costs incurred were higher than the planned costs, so we are having a 1,411 adverse variance. Now let's look at this other variance, the efficiency variance. Okay, actual hours worked, we are told that these were 23,100. Okay, then standard hours of actual production, okay, we know that we produced 6,000 units. Okay, and each unit requires fixed overhead hours of how much? From the standard cost card, requires 4 hours. All right, so multiply by 4 hours. So obviously each unit requires 24,000 hours. Okay, now this gives us the difference of 900 hours. Now, if the actual hours were lower than the planned hours, then we did the right thing. This is a favorable variance. We then have to multiply by the standard cost, standard fixed overhead cost per unit. From the question, this is $3 per unit. Please verify. So obviously, our variance should be 2,700 favorable. Now, the last variance in the fixed overheads category should be the capacity variance. Okay, the actual hours worked 23,100. What about the budgeted hours? Okay, we budgeted to produce 5,800 units. Okay, apply by how many fixed overhead hours we require each unit 4 hours. So 5,800 multiplied by 4 hours, we were looking to work for 23,200 hours. Remember, these are hours. So obviously we worked 100 hours less, so this is favorable. Okay, applied by standard cost, fixed overhead cost of $3. So we are having a $300 favorable. Okay, so you can see that these are the variances, ladies and gentlemen. In terms of capacity variance, efficiency, we were favorable there, but in terms of expenditure, we incurred a lot of expense, a lot of money outflows when it comes to the fixed overheads. Okay, they exceeded our budget. However, we were a bit efficient, which could set off. The efficiency was 2,700, so we could set off in terms of fixed overheads. We are covered there at the end of the day. Okay, we may as well calculate the sales variances. Okay, we can calculate the sales variances using the data in the Zulu example. So we can relook at the Zulu example here and come up with the sales variances. Okay, and these are just two. We are looking at the sales price variance and the sales volume variance. Okay, so the information we might be interested in for the purpose of sales variances, we are looking at the sales here. Okay, the actual sales, we need that information, and some of the units, the actual units, these ones, we need them. All right, as well as some budgeted units as well. Okay, so let's start with the sales price variance. Sales price variance. The sales price variance is based on actual sales at actual price. The actual sales at actual price, ladies and gentlemen, this one is given in the question. The actual sales at actual price, as you can see, that's 423,200. Okay, and then the actual actual sales at standard price, at standard selling price. All right, we are told that from this question we actually sold 5,400 units. So 5,400 units applied by the standard selling price. Standard selling price, ladies and gentlemen, is $85. So that's 459,000. Okay, so obviously our variance is 35,800. Okay, is this variance favorable or adverse? All right, the actual sales were 423, but according to the budget we're aiming to get 459,000. So obviously this is adverse. Now, what about the sales volume? Okay, let's talk of the sales volume. Sales volume variance. Now, this one usually is subject to our costing positions. If we are using marginal costing, the answer is likely to be different from when we are using the absorption costing technique. So in this case, we are using the absorption costing technique. Therefore, our answer is going to be based on the budgeted profit. But if we're using marginal costing, then the answer should be based on budgeted contribution. So simple as that, because in marginal costing, we don't have fixed costs. This is why we use contribution. I'm sure we're going to do something about the marginal costing solution. So in this case, we are using absorption. So we are going to have actual sales. These were 5,400 units. All right, and then budgeted sales. These were 5,000 units. So obviously we are having 4,000 units. All right, the 4,000 units simply mean that we have, the 400 units, they simply means that we made some surplus. Okay, some excess. So that's favorable variance. All right, it's favorable. Then we have to multiply this by standard profit. Multiply by standard profit. As I've already explained, if we're using marginal costing principles, then we're going to say multiply by standard contribution. In this case, we are going to use standard profit, but we need to determine this standard profit. The standard profit can be determined, as you can see here. The standard cost per unit is $63, and the budgeted selling price is 85. So 85 minus 63 is going to be 22, which is the budgeted profit. That's our budgeted profit. So we come here and say budgeted profit, where are you? And we get it as 22. So obviously we are going to have a variance of 8,800. This is, like I said, this is favorable, as we made more sales. We were planning to sell 5,000 units, but we did sell 5,400. So we ended up having a surplus of 400 units. Okay, that's a favorable variance, and in monetary terms, we then have to multiply that one by the standard profit, and we got $8,800, which is favorable. Okay, let us do the same if we are using the the marginal costing technique using the same figures. Okay, using the same figures, we can see that the sales volume variance would look like this. Sales volume variance. Okay, when it comes to the sales price variance, it will be just the same, but the difference will come to the sales volume variance. So we are going to say actual sales. Actual sales were 5,400 units. Then budgeted sales, that's 5,000 units. 400 units. Then we have to multiply by the budgeted contribution or standard contribution. The contribution here, using these figures, for the contribution we're only going to use $25, $18, and $80. So if we add up these figures, 25 plus 18, that's 43, plus 8, that's okay. So this means that our variable cost total is $51. All right. So if we match this with our selling price, we know that contribution is equal to selling price minus variable cost. So therefore, $85 minus 51 should give us minus 85, $34. Okay, so this means that our budgeted contribution is $34. So we come here and say apply by $34. Okay, if you multiply by 34, you should get your that's 34 multiplied by 400. So you must get 13,000. Sorry, 34 multiplied by 4. Yes, 13,600. Now the question is this favorable or adverse? Obviously, this is favorable. Okay, because it is emanating from these figures. Here we are having more sales. Okay, we're having more sales versus the budgeted ones. So this is favorable. Okay, now there is only one fixed overhead variance that is calculated in the marginal costing arena, and this is called the fixed overhead expenditure variance. All right, this is based on actual total, the actual total fixed overheads. From the question, we know that they were $71,011. Then budgeted total fixed overheads. Budgeted fixed overheads. These are based on the units production budget, the quantities which were budgeted for. That is 5,800 units. Okay, multiplied by the standard cost of overheads per unit, or fixed overheads per unit, which was $12, if you still remember, in our cost chart. Okay, let me drive you this one. So This should give us 69,600. All right, and then we get a variance of 1,411. This variance is adverse. Why is it adverse? Because the actual cost was higher than the planned cost. This one. Okay, I think those were the variances I wanted you guys to have a look at. Now, as you can see on the screen there, these are the main reasons or the general reasons that lead to variances. Okay, inappropriate standard. Sometimes we set an inappropriate standard that is commensurate with what is obtaining or prevailing in the market. All right, for example, a material price standard may have been wrong if an old price was used or the wrong type of material was priced. Inaccurate recording of actual costs. For example, if timesheets are filled in incorrectly, this may lead to variances. Random events. Examples include unusual adverse weather conditions and a flu epidemic or the COVID-19. This may cause additional unforeseen costs. Lastly, operating inefficiency. If the variance is not caused by inappropriate standards, inaccurate recording of random events, then it must be due to operating efficiency. The operating efficiency may be due to controllable or uncontrollable factors. Now, the significance of variances, we have already tabled out these ones. The interdependence of the sales price and sales volume variance is remarkable. A reduction in the sales price might stimulate greater sales demand, so that an adverse sales price variance might be counterbalanced by a favorable sales volume variance. Similarly, a price rise would give a favorable price variance, but possibly at the cost of a fall in demand and an adverse sales volume variance. It is therefore important in analyzing an unfavorable sales variance that the overall consequence should be considered. That is, has there been a counterbalancing favorable variance as a direct result of the unfavorable one? Okay, now let us try to answer these two exam questions. They are exam standard questions, and we might be helped if we have a look at them. Which of the following is the most appropriate cost accounting term for the difference between a planned, budgeted, or standard cost and the actual cost incurred? So the difference between the planned, budgeted, or standard cost. These, ladies and gentlemen, these are one and the same things. They mean the same, these terms: planned, budgeted, or standard. Okay, so the examiner is saying, which appropriate cost accounting term shall we use for the difference between planned, budgeted, or standard cost and the actual cost incurred? Shall we say that's the efficiency? Obvious, this is not. Again, we don't call that one surplus. Of course, we might be using the term surplus or deficit, but in cost accounting, the proper term to be used is variance. Okay, variance. So this actually makes the demarcation or the difference between a layman and a cost accountant. Now, there is this particular question which could be of interest to us. A company has recorded the following variances for a period. Sales volume variance was 10,000 adverse. Sales price variance 5,000 favorable. Total cost variance 12,000 adverse. Standard profit on actual sales for the period was 120,000. What was the fixed budgeted profit for the period? Now, how do we determine the sales volume variance? Of course, we are given the figures there that shows this variance. the sales volume variance. Okay, let me call it SVV, sales volume variance. This one is given by budgeted sales units minus actual sales units, as we have just did. Actual sales units. Okay, or multiply by standard profit per unit. And in this case, we are told that this was 10,000 adverse. Then the standard profit on actual sales was 120. Standard profit on actual sales. This one is given by actual sales multiplied by the actual sales in units, rather, actual sales units multiplied by standard profit per unit. And we are told that this was 120. Okay, now the fixed budget profit is given by the sales volume variance. Okay, sales volume variance. All right. All right. Okay. Let me just refresh that one. We get the. All right. The fixed budget profit is actually given by the standard profit. Okay. The standard profit on actual sales. Okay. The standard profit on actual sales. All right. Less the sales volume variance. All right. So in this case, the standard profit on actual sales was given as 120,000. Okay, minus the standard volume. I mean the standard volume variance of 10,000. Okay, this is a minus okay situation, and we are having 130. Okay, that is it. So our answer should safely be T. Now, for the purpose of illustrating our this concept further, we can as well utilize the example which we have been dealing with so far, the example Zulu, okay, to illustrate if we can as well confirm that this formula is safe and sound. All right, so let us use the figures in the Zulu question. All right, let us just use the absorption costing profits. Technique or figures. Now, here we determine our sales volume variance. All right, and we have realized that the budgeted fixed profit, rather, okay, the fixed budget profit, the fixed budget profit, we agreed that this should be equal to the standard profit of actual production, okay, of actual sales, standard profit on actual sales, the standard profit on actual sales minus sales volume variance. Okay, standard profit on actual sales minus sales volume variance. All right, so the actual sales, according to the Zulu question, the actual sales in units, were 5,400. So we are going to say 5,400 units, okay, multiplied by the standard profit. The standard profit is the $85 selling price minus the $63 from the cost card. The $63 is this one, and the 85 is that one, the standard selling price. So we get our standard profit here. All right, minus our sales volume variance, and we have determined the sales volume variance to be 8,800. Okay, and this one, in this case, the sales volume variance is positive, so we do not have a situation where we are having a minus. So we then have to move on and say 5,400 multiplied by the difference here. The difference is 22. Okay, minus 8,800, and let us use our calculators. 5,400 multiplied by 22, that's 118,800 minus 8,800 minus 8,800, we get 110,000. This is the fixed budget profit, or the original budget profit. So for Zulu. Now, if we go to our original budget as we calculated in the initial parts of this video, remember, don't forget that here we determined 110,000 as the original budget profit, the fixed budget profit. So we go here and verify to see if whatever we have been doing so far is consistent. You can see that we are having the same figure here. We are having the 110,000 as our original budget profit, the original fixed budget profit. So the formula is safe and sound. Okay, and ladies and gentlemen, I hope you have benefited a lot from this presentation, and I do advise that you guys consider becoming formal students wherever you are. All right, just become one of our students, and you will discover that learning ARCA has been made easier. Okay, so if you want to engage me, please feel free to send me an email on the supplied email address, or you can as well get in touch with me online, on WhatsApp, +263 774 596 368, or you can simply visit my website at www.transcal, it's one word, transcalconsulting.co.zw. Okay, and we do offer you all the coaching you need in as far as the ACA qualification is concerned. Please like, share, or subscribe to my channel. All right, like or share this video, or subscribe to my channel, or click the notification bell so that you'll be alerted whenever a new video has been uploaded. Until next time, may the good Lord continue to bless us forever and ever. Amen.